Hi, I'm Dr. Kevin Milo, and you're listening to the Physician Empowerment Podcast. At Physician Empowerment, we're focused on transforming the lives of Canadian physicians through education and finance, practice transformation, wellness, and leadership. After you've listened to today's episode, I encourage you to visit us at phys-empowerment.ca, that's PHYS, empowerment.ca, to learn more about the many resources we have to help you make that change in your own life, practice, and personal finances. Now on to today's episode.
All right, so welcome everyone. This is a breath of spring, at least I'm speaking from Edmonton, Alberta. There's a bit of sunshine, snow is melting. I took a bunch of pictures of snow crystals, which is kind of cool. And I wish everybody else have good spring weather. So we're gonna start our session and then we'll entertain some questions at the end maybe. So I'm really excited to have Robyn Fenske. I've known Robyn for a dozen years maybe. And then we're going to talk about white coat and smart mortgages. And so because when we talk about wellness and financial freedom, financial literacy, total package of wellness, I think we cannot escape this mortgage thing. So I would dive right into it. So Robyn, thank you for joining Physician Empowerment Podcast, a live webinar, and we reach out to not just physicians, to all incorporated professionals, healthcare professionals, and even some business owners. So mortgage is a space that everybody kind of mostly have some, right? One or more, or maybe zero waiting to have one. So let's talk about how we met, right? Because I always tell people I invite interesting guests to help physicians live better lives. So I think Robyn and I met a long time ago to help me live better life. I was working crazy hours, and my business partner was telling my wife that Wayne should exercise more. So we've been talking like this for a long time. And you know what? There was a Wednesday morning or something, Monday or Thursday.
Yeah, Wednesday, 8 a.m. Still remember.
It took me 4 years to carve that time out because it's regular days, right? Regular weekdays. It's really difficult. And I'm glad that we did that for body training. And then guess what? Robyn morphed and she's multi-talented, and now she is a mortgage broker. So can you tell me a little bit of your journey, how you morphed from that and being a mom, busy kids, and how do you juggle all the balls?
Yeah, so I came out of university with a kinesiology degree, and that's how I met Wing. And then obviously throughout COVID, gyms were closed down. I've always been really interested in building like a real estate portfolio and how that whole process works. Obviously, during COVID, everything was heightened. You heard a ton about the interest rates and the inflation rates, and then the gyms were closed. At that point, I had two young kids. I was home with them more. And then that it kind of just organically morphed into doing that and leaving the gym. So I always say people think it's a huge difference, but it's both one-on-one with clients and helping them along the way, whatever that journey is, whether it's fitness or home ownership or investment. So even though it seems very different, for me, it felt very similar.
Well, we're on the helping profession in different capacity. Okay, so let's dive into it. Mortgage. I want to dig into some mortgage basics. Okay, so let's dive into some. We all thought we knew mortgages, but we really don't, right? The terms that we sign a life away. First of all, the word mortgage is like marriage till death do we part, like the morgue, right? And there's a mortgager, there's a mortgagee. So let's talk about the most common one. Everybody's interested in rate. What is a mortgage rate, and how does that morph?
Yeah, so mortgage rates is basically what you're getting offered by the lender, depending on the property, depending on the file. So, there's all the talk between fixed rates versus variable rates.
Mm-hmm.
That's the big thing you'll hear in the media, the mainstream media. So, a fixed rate gets affected by the bond yield. So, we've actually just this week seen the fixed rate start to climb up again, just because of the bond yields are also kind of headed that way with the political uncertainty in the world. So that's the one rate you can choose. A variable rate is going to be your prime minus or plus rate. So that's the media where you hear the Bank of Canada rate announcement. That's your variable, that's your prime rate. And then you'll get, your rate will move with that announcement. So if the Bank of Canada lowers the overnight rate, your rate's going to come down. If your Bank of Canada raises that rate, then your interest rate goes up. So
Right. Now let's stop right there, because I don't think everybody is really up there thinking about these things, right? So if you have a fixed mortgage, then the Bank of Canada overnight rate does not impact you,
no.
right? Because it's a long-term bond yield, right? Which is different kind of fish altogether.
Yeah. And with the fix, when you sign your mortgage documents for whether you get a 2-year, 3-year, 4-year, 5-year term, that rate will stay the same for the remainder of the term.
Right. Okay, let's dive into term. So why there's 6 weeks? I mean, six months. 1, 2, 3, 4, 5, and then there's 10. So how does one choose?
Well, that's a loaded question.
Of course.
I feel like it really is person specific. A big part of it when I talk to my clients is based on risk tolerance. So historically, if you take a look over the last 50 years, a variable rate is probably going to save you the most amount on interest, but you have to be able to be flexible with the payments going up or down. I know lots of people got burned pretty bad in COVID because that was a historically high time for the overnight rate. But then a fixed rate, you can lock into, like you said, the 1, 2, 3, 4, 5. And I find sometimes people want to do the 3 because they're thinking, oh, in 3 years, I can renegotiate this, whether it's going to be higher, lower. Maybe we want to pull out equity. It's going to give me a shorter amount of time to renegotiate my mortgage. Whereas a 5-year, you're going to be more like, I want to lock in, I want to pay this rate, and I don't want to be bugged about it for 5 years. So I find those are kind of the 2 train of thoughts when people are picking a term.
Now, 4-year is election year. So some people spin that together. Is there any truth that with the election affects the rate?
For sure, because I mean, the bond yields really get affected a lot by the political environment, right? You'll see it with wars, you'll see it with tariffs. That's when those bond yields will start to rise, and therefore the fixed rates start to rise. Again, yeah, depending on when you get your mortgage and when elections are coming up, people will definitely take that into consideration because they either don't want to be renewing right after an election or they want to be renewing far enough ahead of an election as well. So yeah, you're right. That can affect it.
So what about the war? Does the war, geopolitical upheavals, does affect the rate?
Yeah, again, that's what we're seeing raise the fixed rates currently. Like this past week, we got an email yesterday saying rates are rising, bond yields are up. And then we got another email today, rates are rising again. So, I mean, variable rates are really good right now, but I do say to people, if you don't have that risk tolerance, we aren't in a stable climate. You might want to think about a fixed rates, but it's always a personal decision.
It is. Now, and then while we're on before we leave rate, you were just telling me before we started here, rates are different from province to province. That's
Yeah.
crazy.
Yeah, so I mean, it can depend. Some lenders will only lend in specific provinces. We'll kind of touch on this later, I think, but if you get more to your credit unions, some lenders will have lower rates in like the GTA area. Yeah, so it can affect a different rate sheet per province. We always have to put in the province to get the
So the
current.
same lender, same bank, but different province have different rates.
Yeah.
Isn't that crazy? Right.
Mm-hmm.
And so which is the most expensive province now? Which is the cheapest?
Well, the BC credit unions are super competitive, but I mean, I wouldn't call BC the cheapest. It's
Right.
a pros and cons, right? Their property values are so much higher, but
Right.
you're going to see higher probably in the smaller provinces just because for the lender, it's a higher risk, right? You'll see like in the Saskatchewan, Manitoba, depending on the lending areas, if you're
Right.
not within, 25 to 50 kilometers of a major city, they can put a premium on the rates there depending on the product. So yeah, there's a lot of factors. So when people people look online and they say, I saw an ad that you can get, 3.5 and my uncle 20 years ago got it. Can you get me that rate? I'm like, let's talk about the whole file, not just the rate.
Right. Now, of course, rate is affected by many other things, right? And then, so it's the address of the mortgage, not your home address necessarily, right?
Yeah.
Right. It's a property address, right? So if you,
Property address. Yeah. Like
right,
the property that the file would be
right, yeah.
attached to.
And then,
Yeah.
of course, there's credit rating and all that. Now, how can we do just a mini second on that? How do
Yeah,
we,
mini second on that. So if you're in an insured product, meaning less than 20% down and you'll need the CMHC or Canada Guarantee Insurance, they are looking usually for 680 or higher for your Equifax score. If you have a lower credit score, they'll entertain sometimes some files over 600 with a good reason behind it. And then we can look at alternative lenders, which is a B lender. So your rate's going to be a little bit higher. There might be some extra fees on that file as well, but they will look at files anywhere from sub 500 even. So credit score does make a big difference, but there's kind of, it's not a make it or break it always.
right? A while back, we heard about all these stress tests that made a lot of people not eligible. Are these, now, of course, we have our stress test in medical field. This is different, more stressful sometimes. So, so is this still a thing, stress test?
Yeah, so when we qualify you at the contract rate plus 2%. So when we get a mortgage application, we run basically, I mean, you guys are all numbers people. You run like money in and money out monthly, and we have your GDS and TDS ratios, which is like your total debt service. And we qualify you at like the rate you want plus 2%. So if you're getting a 4% rate, we're qualifying you at 6%, even if it's a fixed, not just on variable.
Got it. Got it. Okay, good. Let's go into lenders. You just talked about lenders. So people just thought, hey, the big five, right? They whatever you call it, Schedule A bank. That's it, right? But there are more. There are more, right? So can you give us a landscape? Who's who in the zoo for the lenders?
Yeah, so we're seeing like monolines are institutions that deal in mortgages only. So they're not going to have a credit card. They're not going to have like a bank account for you. They're just basically there for mortgages. And there's a ton of them out there. And in the last 5 years, we've actually seen quite a few new players come into the mortgage space. And then of course there's your big banks, right? So they each kind of have their niche products, which we won't get into because that's a whole other other thing. But monolines normally have lower penalties if you were to break your mortgage earlier, and they normally have better prepayment privileges as well. So there's definitely things to think about with both. And sometimes depending on the client's need, the property itself, we'll look at it as a whole. A big bank versus a monoline, we have access to everything. So
there's the big banks, there's the credit unions. Is there a difference between those two?
Not a ton. We don't really have access to credit unions in Alberta. Again, BC, they have some credit unions that will lend in the broker channel. We have access to like ATB, which isn't a traditional credit union, but it's a provincial bank. But they are pretty similar to their prepayment privileges and their penalties as like the big five, I guess we could call them.
Right. And then there's some other B lenders. Can you explain those more unknown lenders?
Yeah, so we kind of, in our broker channel, we kind of have 3 stages. So you would have your prime lender, which is like an A lender. So easy finances, good credit score, easy deal. So then a B lender, it's like if there's poor credit, if we've had some delinquencies in the past that aren't good enough for the prime side yet, or if we kind of need to be creative with your finances and the income, then we'd look at a B lender. And then we have private lending, which is if the property of the person doesn't fit into either of those first 2 tiers, we can go private lending. The farther down the tiers you get, the more of a risk it is for the lender. So the higher interest rate you're going to pay on those.
Right, exactly. So now, I'm going to tell my story, right? we're going to the next level, which is the brokers, right? So I was an A1 very loyal customer to Big Five banks since 1984. I landed in Canada, and the branch manager was actually very nice to me. Actually, she became a patient of mine eventually in the dementia ward. So, but she used to be very sharp. Anyway, so I negotiated using my Chinese skills to negotiate the best mortgage rate, and I heard about mortgage brokers, right? And then I test drove one out of BC, and I found they got me a better rate, like 1% less in Burnaby, the same bank, Big Five. And mine had an explosion, right? Mine explosion, not a big one, small pop maybe. But it was like, wow, how could that be? Like, I've been loyal customer, man. And then the lady told me we have access to 60 lenders. It was like, wow, that's like the universe just, got this impact. so can you tell me, Robyn, so how does this space work?
Another loaded question, Wing. Thank you.
I only got loaded questions.
So yeah, as a broker, we do have access to probably close to 60 to 80 lenders. Most brokers probably work with, I would say, your top 10 or more versus like if you get onto the alternative side as well. But we can shop rates around. It depends too. People will be like, a lender will come out with a promotion. So you said, it was a whole percent lower. A lender might come out and they are like, we're going to give this like quick close 45-day promotion. So if you have a file that fits it, you can get those rates. But with a broker, we're always watching because we don't work for the client. We like work to help the client. So I think it's really important. I always tell my clients, like, a bank, I know some people are super loyal to banks. And if you feel like they have your best interest at heart, then that's for you. I'll tell
good
people,
for you.
yeah, like
if that's
I'll tell
too good
people,
for you.
if that's like, if you're going to die on that hill, then like, go ahead. But I think there's so many things because like I'm looking at my clients' files annually and I'll be like right now, lots of rates are lower. Like it might be worth an early renewal. Is there any debt we need to consolidate at renewal where, we could financially get you farther ahead? If you're paying a high interest, let's like consolidate that. So we're really looking at the files as a whole, not just trying to build our book of mortgage businesses, because that's what banks are just trying to fill that number that they have set aside for mortgages.
Two thoughts. Number one, let me tell you that, of course, I got lots of real estate profiles, very complex. And our clinic, we had, of course, a ginormous mortgage. And the banker said, that's it, sign this, and then we're not going to touch it, even though it's a variable commercial rate. Because, and 6 months later, we said, can we change this? Sorry, we sold it already.
Yeah. So
we
that's
sold
something
it already.
I was going to touch
so they
on
package
too.
it up. They sell you like a piece of pork chop.
1,000%. So with the big banks, especially, I see this at renewals. I always tell people, get the offer from your bank and let me know. Sometimes it'll be super competitive and I'll say, you know what? Sign the papers. I can't beat that. But then other times they're so high. And the reason is when they're high, it's because they're almost maxed out at their book of mortgages. Say they have it set at 100 million. If they're at, right at the top, they're going to jack their rates because they don't really want your business, but somebody else will buy that mortgage from you.
Yeah.
So that can
crazy.
be the big thing at renewals.
Yeah. So now, of course, second thought is we probably not today. We probably really have to have Robyn come back again. We're going to maybe at masterclass level, we'll talk about some strategies, refi, debt consolidation, debt elimination, refi for profit, refi for a better rate. There's a whole bunch of strategies we could do, right, to enhancing your wealth, especially when you're in a pickle, right? The early starters, early first 5 years of professionals, they really need every dime. How do we navigate that? So I think we'll have a different session at a deeper level. But today is just a basic stuff. So, okay, so how do you guys get paid? Let's dig into the ecosystem.
Yeah, so I feel like a common misconception is that our clients have to pay us, and they call and they're like, "Oh, so well, what's it gonna cost me?" And I'm like, "Nothing." So we get paid if we're in between the lender and the client. We're like a matchmaker. So we get the file, we figure out the whole picture, we choose a lender that we think it's going to be the best fit with, and then we bring the client to the lender, and then the lender then in return, we get paid a commission on that mortgage when it funds. So zero to the client. I feel like they're going to get the advice they need, like the follow-up they need, and yeah, it's free to the client.
I could not believe when I talked to a lot of my colleagues, especially when we do physician empowerment, we meet physicians east to west coast and other professionals, and we talk because I'm a real estate guy, right? And I said, why don't you talk to a broker? I'm very loyal. My bank is treating me well. Like, how do you know? How do you even know,
Yeah,
right? That they
exactly.
give you the best deal, like, but they just would not open their mind. It costs you nothing, right?
Yeah.
But qualifier for commercial brokerage is a different deal,
Yeah,
right?
commercial brokerages are it's like a whole other ball game, so
Yeah, you do have to pay the piper, and yeah, so it's a different animal. That's a different session as
it's a
well.
whole other animal.
Yeah, a whole different animal, and I play in that space too. So okay, so that's good. So you guys are there for hire for free to the end users, and you watch you for the interest. And people say, well, how is that possible? Well, there's this thing called the spread, right? They make money. The bank, this is rate, this is their cost, a borrowing, and then there's a spread, and they do have to pay the piper. They either pay advertisement, pay their staff, or pay brokers. Some
Yeah,
banks, some lenders would not allow you to compete with their own sales channel, but a lot succeed of them will, right? And that's
yeah,
the right, and they could get business outside of their regular bank channels. Why wouldn't they, right? Some is better than none, right? So to me, that makes perfect sense economically.
yeah, for sure, I agree.
Okay, so let's move on. Let's getting juicier now. What about those of us who not just have a house, but first lenders. Yes, let's talk about first lenders. There's some exciting programs from the government, incentives for first-time buyers.
Yeah, so we've actually had a couple that have just come out. So if anybody is looking into getting into their first property or have any adult children getting into their first property, obviously
Mhm,
there's the home buyer program, which is the RSP program. So you can use up to $60,000 of your RSPs.
mhm,
It does need to be in your account for 90 days before you draw it out
mhm.
for the down payment, and then that one has to be repaid in 15 years. So that's one that can have.
That's a good deal. 15 years.
Oh, yeah, and more than enough time, right?
Yeah.
Um, and then, yeah, so you don't pay taxes on when you pull those RSPs out. The other one is the first-time homebuyer savings account. So
Mhm,
that's $8,000 a year, and then I always say I have this number, I'm like, if you put $8,000 a year, it's a tax break of 2,400. After 2 years, it's $16,000, and you've saved in taxes $4,800. So you only put in 16, but you have 20,800 working for you. So,
mhm.
and that one, you don't have to keep it in for any amount of time. Like sometimes institutions, obviously, it needs to process. So I would say give yourself 30 days, but it doesn't have to sit in the account for 90 days like an RRSP.
And
So,
then if it's a couple, you double it.
yes, and it's a couple. Same with the RSP. If it's a couple, you can each do 60, so that's 120,000 as well.
Mhm.
So those two programs, I wrote them down here. There's the GST rebate on new builds for first-time home buyers, so you don't pay the
That's right.
GST on that. If new
Yes.
builds only, I was like, say
Right.
it twice. And then
Right.
there's the first-time home buyers tax credit, so it's a $10,000 tax credit, which equals to about $1,500 reduction on your personal taxes. And then the
Mhm,
last one, which is different per each province,
mhm,
is the land title tax refund. So
mhm.
in Ontario, it's $4,000 in Ontario, $8,000 in BC, and $2,000 in PEI.
How
So
about Alberta?
I know, nothing.
There's no
Like I
fairness.
said, every province is always a little bit different. The accounts though are definitely nationwide. It's just some of the land title stuff is province
Right.
specific.
Okay, good. So let's pivot now over to rentals, right? A lot of people, not just their own home, they start to get one or two or three or 15 doors, whatever, how many doors we talk about, right? A lot of people dibble dabble. And so how does that work for lending?
So rentals is different. So you're going to get a different rate too. So again, when you see the advertisement, there's always going to be a little bit of a premium, not much, I'd say 0.5% premium on a rental rate, just because again, it's a higher risk of to the lender. Because it's
So
not your
0.5% right off the hop, higher.
yeah, so say like that's just it's they're always changing, but say it's 4% for owner occupied, you're going to be 4.5 for rental. So
Right.
it's always going to be a little bit higher. I feel like 0.5% is just a good generalization.
Right.
But yeah, rentals are a great way. You do need 20% down unless you do an owner occupied rental, which means you're living in one of the units, whether it be a duplex on one unit, a fourplex on one title, a legal basement suite. We can use that income to help you qualify. And then you would only need 5% down if it's an owner occupied rental. If it's just an investment property, that's where you're going to have that minimum of 20% down.
Right.
And again, for qualifying, we talked before about the money in, the money out. Rentals, I feel like there's a common misconception that people will say, well, I'm going to get $2,000 a month for rent, so I can just add that to my income. And it's not that simple, because most lenders, when you're qualifying, are going to take about 50% of the rent, and then you can add back some things. Every lender is different, so I won't get into specifics, but you're going to see like the property taxes, maintenance. That's why they're not going to take that full 100% of the rentals. So it can help qualify with the income, but I always warn my clients it's not going to be that $2,000 a month, $24,000 a year. That's my income, right? So they definitely, I always want to let people know, like, it's not as simple as it seems.
Right. So let's say, okay, we got one, we're really happy, got the basement rental. Okay, let's buy, honey, let's buy another house and then probably we got that. And then you feel so good about yourselves. And you say, hey, my net worth sheet is looking better and better, better. You go to the bank, okay, so 1, 2, 3, 4. And then I found it a hard way, like, at least for one local provincial bank, 4 was the limit.
Yeah.
By the time you go past 4, they say, sorry, you're too risky. What do you mean I'm too risky? It's positive cash flow every month. No, you're too risky. Can you help us unpack that?
Yeah, I mean, we've had this conversation with lenders because on paper, and we know that they're good, but it comes back to, again, how you kind of said with the commercial, the investors behind the money they just get a little nervous, right? So the banks, it becomes higher risk for them. So, I mean, every bank has their own number, but yeah, it's tough to see a bank over. I think there's maybe one or two that will do over 10. Like 4, I think is your normal now. Like your owner occupied and 3 to 4 rentals is kind of where you're going to max out at.
Well, and so we didn't know right early on. My wife and I just co-signed everything. Then later on, I found, oh, if I had bought 2 properties under my name, 2 properties under her name,
Yeah.
we could have 8.
For sure. And that's something you could do for sure, just like planning. That's why we like to talk to our clients and be like, what are your long-term goals? Do you want to build a real estate portfolio where you have, multiple properties? Let's maybe look at this a little differently, right? Like you said, maybe we'll put some in your name and your wife's name, and then you can really maximize those amounts.
Yeah, so again, that's a discussion for a different day. But I just wanted to include this because a lot of people coming in, they have all these grandiose plans and they didn't think about it, or they're in the thick of, getting a fourplex and all that, right? They're already co-signing, and maybe they do need to co-sign to qualify, right? That's stress test.
Yeah. And I mean, rentals can be a powerful way to grow your wealth and portfolio, but people do really need to take the time and understand the long-term game.
Yeah, and that would be slightly different conversation. Is it corporately held? Is it personally held? Is it residential? Is it commercial? And their strategies, let one rabbit come over the bag, is you max it out and then you bundle them through umbrella commercial, 1% more, but then now you free up your credit limit, right?
Yeah.
That's one way to grow it, right? Or you can do joint venture partnership with others, right? There are different ways to build things up, right? But that's for a different day, right?
Yeah.
Awesome. Well, this is cool. So thank you, Robyn. This is very compact and lots of stuff. And then finally, you said there are some lenders that have juicy programs for MDs.
Yeah, for sure. So
I would like to
especially
know.
well, unfortunately, Wing, I don't think you're in your first couple years right out of med school, if I were
No,
to
but there
guess.
are others. We have listeners all over.
No, I know. So yeah, lots of lenders. There's probably 6 or 8 I can think off the top of my head that we normally use have what we call projected income. So if you're in your first 1 to 2 years outside of your residency or you're still in your residency, again, they all have different parameters. So this is a generalization. We'll use your projected income because, they know that there's going to be a job out there, and they know that in the next 1 to 2 years you're projected to make X amount of money, so they can use that income rather than because you are self-employed or a corporation, however you set up your business. Normally for business for self we need a 2-year average, so that kind of eliminates those 2 years waiting for you guys to finish full years of work before you can buy a property. So they give you guys a little bit of a jump start.
Right on. Now, so akin to that is we actually have a huge amount of internationally trained, international medical graduates, IMGs. So whatever credit history they had was in the ocean away, right? In the country that's ocean away, and the brand new start. So how do these people qualify?
So it depends, number one, where they're coming from, because we can use international credit bureaus. For new to Canada programs, we can use if they have their permanent residency, if they have a work visa, your work visa has to be valid for 180 days from when you apply. So, I
Right.
mean, you're kind of getting into 2 programs of like qualifying for the new to Canada rules. But the medical program does qualify international as well. So,
Right. I did a rent to own to one of our new recruits from England or
yeah.
Ireland, way back, right? And this poor guy, he couldn't even use his MasterCard to rent to get a phone or get like, yeah, he couldn't, like, right? And he couldn't rent a house, couldn't, nothing. I have to put him in a hotel. Right? And then it
Yeah.
was okay. So poor
Oh my
guy.
gosh. And I mean,
Yeah.
yeah, credit, again, that kind of takes it back to the credit. I would recommend if you have somebody that comes to Canada, try to get building that credit as fast as you can here, just so
Mhm.
there's something on the books at least, right?
Right. Okay, good. Awesome. So one final question. I know you don't have the crystal ball. Where do you think 2026 is going with the lending environment, and what are some smart perks that we might have to think about?
Oh man, I mean, obviously I listen to so many economists and I have in the past, and are they right? Sometimes, sometimes not. But my personal opinion, I think fixed rates are kind of going to float around between that 4 to 4.5% is kind of where we are now. We've seen it for the last 6 months. They just kind of go up and down a little bit, ebb and flow. And then the variable rates, I don't think there's going to be a huge shift in those either. Like, even though I said earlier we're in a pretty unstable political climate, I feel like the stability of the rates, it's not going to be, I'm thinking like 0.25 or 0.5% up and down by the end of 2026. So
Mhm.
there is a rate announcement next week. I personally think it's going to be a hold, so I don't think we'll see any change there, but as we all know, so much can change, but I do see a pretty steady.
Well, we change our rates, what, how many times a year in Canada?
I think they usually do it, there's 8 or
Something like
9?
that. Yeah,
Yeah.
something like that. Yeah, so everybody should watch out for those. Okay, awesome. This is tons of fun. Thank you, Robyn. I know you're really busy, and we
Yeah,
got
thanks for
kids
having me.
and all that and their activities. And so thank you for enlightening us. Something we thought is basic, but it's not so basic once you open the lid, right? That there's a
Yeah.
lot to it that we thought we knew because it's every day, right? But okay, so thank you very much, Robyn, and thank you. We'll see you another time.
Thank you.
Thank you so much for listening to the Physician Empowerment Podcast. If you're ready to take those next steps in transforming your practice, finances, or personal well-being, then come and join us at phys empowerment.ca, PHYS visempowerment.ca to learn more about how we can help. If today's episode resonated with you, I'd really appreciate it if you would share our podcast with a colleague or friend, and head over to Apple Podcasts to give us a 5-star rating and review. If you've got feedback, questions, or suggestions for future episode topics, we'd love to hear from you. If you want to join us and be interviewed and share some of your story, we'd absolutely love that as well. Please send me an email at kmilo@visempowerment.ca. Thank you again for listening. Bye.